What's going on, guys? Welcome back to the channel, and in today's video I'm sharing with you the truth about startup valuations. In this video I'm going to break down how you can actually value a startup that might be pre-revenue. Maybe the company's making a little bit of revenue, and how you can value it in that circumstance, or if there's a lot more traction and you can value the company that way. I'll be sharing the valuation versus traction matrix that you see here on the board. It was made popular by a famous angel investor, Jason Calacanis, and make sure you watch to the end of the video because I'll be breaking down some of the most common mistakes that entrepreneurs and investors make when it comes to valuing a startup. Now, I'm bringing this information to you as a founder and entrepreneur myself, but also as an investor that is invested in startup companies. So I've not only raised capital for my business, but also invested in other startups from the technology perspective and other. Now, if you guys are interested in this type of content, make sure you check out some of my other videos that I've done on investing in startups, how to make money investing in startups. I have beginner guides that really walk you through how you should think about this step by step and what you should look for in companies. In today's video, we're focusing on valuation because at the end of the day, this is about making a financial return. It's about making money, and if I can help you guys make money by investing in startups and hopefully not lose any money or limit your downside potential, then my goal will be accomplished. If that sounds interesting, make sure you subscribe to the channel, like this video, and let me know in the comments what you guys think about the valuation versus traction matrix, or what other videos you guys would like to see on startups, investing in startups, or entrepreneurship. Without further ado, let's begin. The first thing you want to ask yourself in terms of valuing a startup is, what is the end goal of your investment? Now, obviously, two come to mind. Maybe they're not obvious. They're obvious to me. You want the long-term success of the company. If the company fails, your money will most likely go to zero. So you want to try and figure out, when you're evaluating the startup, how can I make sure this investment has as little downside potential as possible? Ideally, you're optimizing for the upside. When you're investing in a startup, you're really less concerned about downside potential. You're more concerned about upside potential. But you won't see any of that upside potential unless there is a liquidity event. Now, this could be an IPO, an acquisition, private equity firm, or a secondary financing down in the future. Now, your goal of making sure this company is successful, although you don't have much control over it once you've already invested your capital, is to see some kind of an appreciation of value. So if you invest at a $2 million valuation, your goal is for that company to raise additional financing and or have some kind of a liquidity event at a valuation higher than that initial $2 million valuation. So if you invest at a $5 million valuation and the company goes public at a $5 billion valuation, you will have a very, very large return on your initial investment. That's not always the case, but you want to think about it from that perspective. How can I make sure that this investment is going to see an appreciation in the future? Because if the valuation is too high too early, and the founders or the investors have really optimized for a high valuation too early, then you as the investor, you actually don't want a high valuation because it's a lot harder and more difficult for the company to achieve a higher valuation in the future. And ultimately, the company's success depends, in your perspective as the investor, on continuing to grow its valuation. If the company's valuation doesn't go anywhere or it goes down, then your investment will basically just sit there in the company, and it's unlikely that that company that's not growing is going to have any kind of a liquidity event in the future. And that is the worst kind of investment that you can have, because when you invest in a startup, your capital is gone. You have no way to pull it out. Unlike a publicly traded company, even if the company's valuation goes down and you just have to sell your stock at a loss, at least you're getting something back, unless the company goes completely bankrupt. But for the most part, you'll be able to sell even at a loss. In a startup, that's not the case. So that's a huge risk that you need to be aware of. You need to understand how that valuation can appreciate over time. Now, when it comes to actually figuring out what that valuation is, when we think about a company that is pre-revenue, it's really an art and science. You know, it's not like a publicly traded company, which we'll talk about just a little bit, where you can look at these different metrics that are available, whether it's the PEG ratio, forward PE, there's other comparables. You can look at revenue, earnings. You don't really have any of that in a startup because it's so early stage. So if you don't have revenue, and you do have revenue, maybe just a little bit, there are some things that you can look at, which we're going to talk about in just a second. The other option is, if you do have revenue, what are some of the things that you can look for? Well, when you have revenue, and you have enough of it, and we're talking, tens of thousands, hundreds of thousands, most likely millions of dollars in revenue, then you can look at a multiple. And a multiple simply means you take maybe the last 12 months annualized in revenue, and you multiply it by some factor. It could be 5, it could be 10, it could be 20, and that multiple is really what the valuation is. So here's an example. A company is doing $1 million in revenue, and there's a 10x multiple on that last 12 months millions of revenue. So that company's valuation is $10 million. Now that multiple is really determined by a few different things. The margin of the business, so a software as a service business will have a higher multiple because there is more margin. The total addressable market size, if there's a long way to go for this company and a big potential in front of it, it could have a higher multiple because that growth is expected to continue. And I mentioned it, but the growth rate is potentially the most important factor besides the industry and the margin that the business actually has in determining what the multiple is. So a fast-growing company will have a higher multiple. Just some quick examples of what some multiples can be. Software as a service, if the company's growing pretty fast, maybe it's doubling every year or 30% per year, the valuation multiple could be anywhere from 5 to 10x. So in that example of a company doing $1 million in revenue, the company might be valued at $10 million because they're growing relatively quickly. If the company is growing really, really fast, the multiple could be 20 or 30. That's not completely uncommon for a fast software company. What about an e-commerce company? They're selling products online. Yes, it's an online business, but the margin is not going to be as good as pure software. And so the multiple on e-commerce might be anywhere from 1.5, 2, or 3. Again, if the business is growing really, really fast, the multiple might be 4 or 5 or 10. Some of these things are outliers. And the reason why you want to pay attention to this, if you see the company is only doing a few $100,000 in revenue and the valuation is set at 20, 30, 40 million dollars, it just doesn't make sense. And you don't want to make that investment because, like we talked about, you need appreciation in value. There might be too much good news factored in to this investment. Maybe, if everything goes right and they take over the world, then that valuation might make sense and you can see some kind of an appreciation. That $40 million valuation might end up being $400 million in a few years. That's really unlikely. So unless you have some kind of insider knowledge with that company, which you can have in the private world, you can't in the public world, that's called insider trading. But if you have some kind of insight that gives you a lot of confidence that this business is going to be really successful in the private market, then maybe it makes sense. But otherwise, I would stay away from anything that has these crazy high valuations. And now before I talk about this chart and how you actually value the startup, the third option is by looking at EBITDA, which is short for earnings before interest, tax, depreciation, or amortization. Now this is when you're thinking about a publicly traded company. These are much further along companies. These startups, this matrix doesn't really apply because they have so much traction. They have years of revenue growth, and you can actually see from a profitability perspective what the valuation should be. This is more in the public company sense. So if you guys are interested in that, there's tons of videos out there on the internet and articles that explain how to value publicly traded stocks. Today, we're talking about startups. So if the company doesn't have revenue, or maybe it has a little bit of revenue, this chart kind of gives you a little bit of insight as to what the valuation might be and some of the variables at play. So if we break it down, we've got valuation on the y-axis, and we're going to start from 2 million all the way to 12 million. Again, you could have 1 million or less. This is a really technology focus. So again, we were talking about multiples here, how that plays in later on in future rounds of funding. This is a technology perspective. Otherwise, this doesn't really make sense. So if you're trying to open a restaurant, this is not really the best chart to go off of. So bear with me here. Now on the x-axis, we have traction. What does traction mean? It could mean you have an idea. Maybe you've taken that idea and you've created a mock-up. Maybe you have a MVP, short for minimum viable product. So you have a prototype or something that people can actually look at and use in some capacity. Maybe you have pilot programs, paid pilot programs. You put your product in the market in some capacity, and then later down the road, you actually get to revenue, recurring revenue maybe, and maybe it's $10,000 per month, $100,000 per month, and once you get into those bigger numbers of revenue, then you start to look at these multiples and option number 2 and 3 here. Now, when we think about valuation, there's this dotted line right here that's kind of in the middle. It's at a $6 million valuation. And this is kind of like the benchmark as you move through this x-axis. So let's say you have a minimum viable product and you're kind of just you're building a startup, right? There's nothing, you're not a famous founder. You've done something. $5 to $7 million might be a fair valuation if maybe you're pre-revenue or you've just started to get revenue. This is kind of the territory you're in, anywhere from $3 to $7 to $8 million. Now, location does factor into this. If you're in Silicon Valley, you're gonna be able to push a higher valuation for having less traction. If you're not in Silicon Valley, you're gonna need more traction to have the same or even a lower valuation. But remember, having a higher valuation is not the end game. It's the end game at a liquidity event, at an IPO, or an acquisition. When you're early stage, it actually doesn't matter as much. And if you're the early stage investor or the entrepreneur, you wanna avoid setting the valuation too high of a benchmark to reach before your next round of funding, so you might have a down round of funding. That's what you don't want. Now, a few different factors that I want to throw in here. This green line is the average startup. So as time moves on and you build more and you have more traction, the valuation will go up. And these outliers are other variables that take effect. So for example, let's say you do a startup accelerator. Normally these programs have a fixed valuation, fixed terms. That's actually much lower. Normally, $1 to $3 million valuation, or valuation cap rather. And it doesn't really matter how much traction you have. So you could be making, $100,000 a month in revenue. Heck, you could be doing $1 million a month in revenue, and you're still gonna be at a fixed $2 million valuation cap. On the flip side, if you're Elon Musk, he's a crazy example, but if you're a successful serial entrepreneur, investors will have more confidence in you, and you can have less traction, and you can have a higher valuation or valuation cap. And so when we have quadrants here, a higher value in the eyes of the investor is obviously a lower valuation for more traction. You're getting a better deal. If you have to deal with a higher valuation for less traction, you're technically not getting as good of a deal. Now, if you remember what I talked about in the beginning when it comes to that liquidity event, ideally the company is much, much more valuable than when you're investing. So if we're talking about a $12 million valuation, if you're investing here and there's very little traction, you're very bullish and excited about this company's opportunity to 10 or 100x its value. If it's at 10 million or 12 million valuation, you want the company to sell for at least $100 million, or else you don't really want to be playing in this category, because there's a lot of potential that the company goes nowhere, because the further along you are down this road and the more revenue you make and the more profitable you can be, the less risky the investment is. So if you're investing at the origin point, at the idea, you have the highest risk because nothing has technically been done yet. And if you're investing at the highest valuation, that might be drawing some red flags, because you have to really believe in that famous founder, that entrepreneur, that they're gonna be able to execute, de-risk your investment, and justify that higher valuation down the road. Now, I have a few other things on here. I have Silicon Valley, non-Silicon Valley. I have YC. This is a different kind of startup accelerator that is probably the most prestigious in the world. And at their demo day, even though their terms are at that, 1 or 2 million, I forget what it is exactly, valuation cap, at the demo day, a lot of these companies will raise at 10 or 15 million valuation caps, sort of regardless of where their traction is at. That's kind of at a minimum. It'd be very difficult to find a company at the YC demo day raising anywhere from, $3 to $5 million, even if they're super early stage. It's just not gonna happen. So if you're the investor and you're looking to make an investment, you don't want to be investing at the lower value, obviously, unless you personally know the founder and you really have good conviction about this market or this entrepreneur. You want to be finding these higher value companies. And if you see a company that has a lot of traction and they're raising at a very low valuation, you also want to, intrigue as to why the valuation or valuation cap is so low. What is wrong? What have you missed in their financials or the market or the multiple that really is causing this? I'll give you a quick example about my company and how we raise money. Here's an example. We raised in 2017 at a 5 million valuation cap online on WeFunder through equity crowdfunding. In that round, we were 5 million valuation cap. We were past the MVP. I mean, we were App of the Year by Apple. So we had a little bit of revenue, but it was still very early. So I wouldn't say, we weren't even 10,000 per month, I don't think. We were, sort of in this territory. So, at a 5 million valuation, so we were probably about here. Fast forward to 2019, we raised again, equity crowdfunding on WeFunder at a 10 million valuation cap. So just following this chart, you'd expect us to be about here, 100K per month. and we were on that track. I think in that month where we opened the round, we were around 100,000 in revenue. So as you can see, over time, as we de-risked the investment, we made more revenue. Our valuation cap, we doubled it. Now, if you guys are interested in how we raised over $500,000 through equity crowdfunding, I did a video specifically on that. Make sure you check it out. I'll link it in the description. Now, one of the dangers of high valuations that I didn't really talk about, obviously you don't want to invest at too high of a valuation or the entrepreneur, because you might not get to that and you might have a down round, and the whole point of being an investor is that you see an appreciation of your investment. Now, also to consider, the lead investor or the venture capitalist, or on Shark Tank it'd be Mark Cuban or one of these investors, they're the ones setting the valuation of the investment round. It's not you, the angel investor, that's coming in. If you're watching this video, you're not the one setting the terms. So it's really important that you look at this and you decide for yourself if that investment is a good opportunity, because the valuation has already been set. This is not really negotiable unless you're the entrepreneur. You can negotiate with the investor. And finally, 3 mistakes that entrepreneurs and investors make is, number 1, comparing your startup to a startup that just sold in the public market or was acquired recently. There's so much information that you don't know about the growth rate, the revenue, the motivation of the acquiring company as to why they bought that company, why they made that investment. And so because of that, it can be dangerous to set your valuation marks based on a company that was recently acquired. Now, on the flip side, that might be the best information that you have, so it's not necessarily a bad thing, but you don't want to put all your eggs in that valuation just off of what another company did. That wouldn't make any sense. You want to look at other variables, other factors. Number 2 mistake is comparing to a public company. Yeah, this doesn't make any sense. Now, the public company, the public market can be very volatile, emotional, but at the end of the day, you're going to return back to these KPIs. You're going to look at profitability, earnings, forward PE, trailing PE, PAG ratio. All of these things actually matter in the long run of a public company. In startups, most of that stuff doesn't matter for the reasons that we talked about. You might be, a little bit of revenue or pre-revenue, so none of that really matters. What matters is, this level of traction, the founder's conviction, the supply and demand of investment capital and the startups in the ecosystem. All of that factors in. So don't look at a public company. And thirdly, using a one-size-fits-all approach. We already talked about this. Basically, you have different multiples for different types of companies, different industries, different locations. If you're raising, professional investors, if you're raising online equity crowdfunding, regulation A, regulation D, right? All of these things factor in to what the valuation of the company is. But if I had to summarize this entire video, what you need to do is you need to make sure that you understand the variables at play, what the valuation is of the company today, and how that compares to the traction and your thoughts on where the company can be in the future, so that you can see an appreciation of your investment based on the future value of the company. I hope this answered some questions on early stage valuations, startup investing, or building startups in general. If you guys enjoyed it, make sure you give it a like and let me know in the comments what you think and what other videos you'd like to see from me. And with that being said, wish you guys the best and keep hustling.